Hey guys, this is Ehab. Today we're going to talk about the 10 investment mistakes that are made by beginners. And since we made a video before about 10 investment tips for beginners, I thought about making another video for the investment mistakes that I've seen beginners do and how to avoid them so they don't really have to make those mistakes. So mistake number one is investing before you're ready. And what I mean by that is just because you have $100 or $500 or even $1,000, that doesn't mean you can go ahead and invest it right now. You're going to have some kind of an emergency fund in case something happens where you need the cash. It's never a good idea to go and tap into your investment unless you really have to. And that's the purpose of having an emergency fund. The reason for that is because you don't want to go into your investment and break into it and pay taxes on that, or even get penalized in case of, a 401k or an IRA account. You don't want to do that unless you really have to. So keep an emergency fund on the side and then try to invest whatever you have extra into an investment or even a retirement account. It's also a good idea to pay all of your high interest debt first. And what I mean by that is the credit cards, anything that has a high crazy interest, go ahead and pay it off completely before you start investing. That way, the money that you're making out of your investment is not going to be eaten up by the high interest where you're being charged on the back end by the credit card companies or whoever it might be. So besides a mortgage and a student loan maybe, you shouldn't really have any kind of high interest debt before you begin to invest into the market. So mistake number two is setting unrealistic goals. When you try to go into the market and invest into it and try to make some money out of it, always keep in mind that you're making some money. You're probably going to make it over time, first of all. Second of all, you're not going to be making these huge gains unless you're day trading, which, if you're a professional, maybe you can do it. And if not, then you're probably just gambling. And in my opinion, that's not a good strategy to invest into the market. But if you're investing over time, set a realistic expectation that you're getting the average market over time, which is 10% historically. Some years you'll see the market, spike up into like 25% or even 30%. And some years it will drop 25% or even 30%. So over time, just keep a realistic expectations, what you're going to be earning from the market. And don't make the mistake of setting unrealistic expectations that the minute I'm going to invest into the market, I'm going to make a lot of money. And if I don't, I'm just going to pull out and forget about it. Now, mistake number three, which I've spoken about in a different video as well, you shouldn't really be investing into something that you don't understand. So don't buy the penny stocks, don't buy the biotech stuff, don't buy something complicated that you really don't know what they're doing. What kind of company is it? What are they producing or manufacturing or whatever the case might be? Try to avoid these companies because you don't understand what they're doing and most likely you don't know how they're going to perform over years. So you want to focus on companies that you understand well, you've seen around you, Walmart, Amazon, Google, Apple, things like that, where you see it on your daily life and you probably use it, or you have friends that use it. Those companies can get you a good return because they've been around for a long time, and at the same time they have a track record of proving that they actually get you the return that you think they will get you. Now, mistake number four is paying too much in commissions. And what I mean by that is when you have an investment into multiple different brokerage firms or apps, or whatever the case might be, you're probably spreading yourself too thin where you're purchasing and buying and selling into different platforms, and each one have their own cost or fee structure. And they're probably charging you money in the back end, whether when you buy or when you sell. It just depends on each company. And you're paying a lot in commissions. You really shouldn't do that because that money could have been invested and get you a lot of high return instead of just trying to give it to different brokerage firms where they can just charge you for the transactions that you're making every single day. Now, mistake number five is trading too frequently. And in my opinion, this is a killer because the more you trade, most likely you're not making that much money on it to begin with. And second of all, you're probably paying a lot in taxes that you just don't know about it because that doesn't hit you right then and there. It's going to be at year end when they're going to send you the 1099 and you see all these transactions in the back end where you bought and sold different stocks. You're going to pay a lot in taxes on these things. So in my opinion, this is a detrimental mistake. Keep in mind that the longer you hold it for, the better it's for you. There was a recent study that I've read that says, which you just want to take the idea behind it and what the study is actually meant to show you. The retirement accounts that have performed the best and has the highest returns are the retirement accounts or investment accounts for dead people. And that's funny and sad at the same time because, dead people, they can't really control or buy or sell or even do any kind of transactions or any changes to their accounts. Hence, they're leaving the account alone because they're dead. And at the same time, they're getting the highest return because they're not really touching their accounts. So the longer they leave it alone, the higher the return they're getting because they're dead. So the gist of the story is that the longer you leave it alone and not touch it and keep buying and selling, the better it's going to perform for you. Now, mistake number 6 is buying and selling based on emotions. And I have seen this pretty much across the board because this is a human nature. This has nothing to do with you being a beginner or advanced or whatever the case might be. It's just a human nature that the more scared you are, the more fearful you are when something happens, most likely you're going to react to those emotions. And when you are happy, when you think, the market is doing great, when you see high returns, most likely you're also going to react on those emotions. Whether you're going to buy or sell, it just depends on the situation itself. That's also a big mistake. You're going to have to control your emotions when things are bad and when things are good. You're going to have some kind of control where you say, okay, I know this is temporary, whether it's good or bad, this is going to pass. And then after that, we're going to go back into the same routine where you're getting the same returns over and over again. So if the market goes down 25%, or whatever the number is, just like how happened in COVID when the market, went down significantly. If you don't react on those things, or even if you react positively, for example, you purchase even more or invest even more because the market has actually went down, that's a good thing. But if you do and, freak out or you think, okay, this is going to be the end, I'm going to lose all my money, I better sell right now and just get out of the market. That's a terrible strategy. You don't want to do that because you're going to lose your money and not going to get any of your investment back. You're probably going to get some money when you sell it, but you're not recouping a lot of your investment. So if you have left it alone and you have seen how the market reacted between COVID and nowadays, it has done significantly well. So if you have just left it alone or even invested when COVID hit and the market went down, you made a good chunk of money between now and then. Now, mistake number 7 is not making use of index funds. And what I mean by that is you focus on purchasing just individual stocks and picking out different companies, and that can get really hectic because you're going to have to read about those companies, read their 10K report. You're gonna have to think about multiple things before think about buying into these companies. So it's very difficult to try to weed out which is the best company and how much return they're going to get you, and not make use of an index fund which gives you a broad diversification over 500 or so different companies. So if you take the S&P 500 for example, you invest into that index fund and automatically you're diversified completely. And you're investing into 500 different companies, you're getting the average market return, guaranteed almost. You're not going to think about it if it goes up or it goes down. You pretty much know the historical value is going to be, around 10% or so is going to give you a return. So you don't have to really think about it that much. Just make use of an index fund regardless if you try to purchase stocks, individual stocks on the side or not. Just make use of an index fund. Now, mistake number 8 is not rebalancing your portfolio. And this often happens without you even noticing that it happened. So let's say, for example, you started the investment, journey and you thought, okay, I'm going to invest 75% of my money into stocks and 25% into bonds. Over time, even if you leave it alone, you don't touch it, you don't do anything, you did the right proportion, the way you wanted it to be, 75% stocks, 25% bonds, over time, the value of the stocks, they're going to outperform the value of the bonds and they're going to take over. So it's going to be 90% of your portfolio stocks, and then it's going to be just 10% bonds. So that proportion is not the same as when you intended it to be when you first started. You wanted it to be 75% stocks, 25% bonds. At that time, you're going to have to rebalance your portfolio. So at that time, you're going to think, okay, now I have 90% stocks, 10% bonds. Okay, I'm going to have to sell portions of my stocks to rebalance it and then put it back into bonds. That way, I'm going to go back to my original 75% stocks and 25% bonds. You also have to keep that in mind if you think about retirement. So that's way ahead into the future, hopefully, but you have to think about it. The closer you're getting to retirement, the more conservative your portfolio you're going to have to be, because you don't want to risk it as much. And that way you're going to have to rebalance it at that time. So don't make the mistake about just you're going to invest it, leave it alone, and forget about it forever. At some point, you're going to have to revisit and rebalance your portfolio so you can get the same proportions that you think are good fit for your investment. Now, mistake number 9 is using borrowed money, which it's called margins, using margin to invest and get into the stock market. That's never a good strategy, in my opinion. Don't use borrowed money to invest into the market and then you have to pay that money back. Most of these brokerage firms, when they give you the money, they're taking your own investment as a collateral against it. So if you borrowed some kind of money and you're trying to invest into the market, they're going to take your own investment, whatever balance you have, as a collateral. And then if you lose on those monies that you invested into the market, they're going to automatically get you a margin call, and then the brokerage firm will get you to sell some of your stocks or bonds or whatever investment that you have with them to liquidate it and then give them their money back. And then on top of that, I have seen brokerage firms where they charge 8 to 10% interest on that margin that they have lent you, which is basically a borrowed money. They lend you the money, you have to pay interest on it. Okay, well, you think about it, just mathematically. How much in return you have to get on your investment in order for you to pay them 8 to 10% interest, and then you make some money on that money as well? How is that even possible? And even if it is possible, that's a very expensive way to do it. You might as well just save up your own money and invest it. And in that case, if you lose it, it is what it is. But if not, you're making some money out of it. And at the same time, you're not really paying interest or trying to pay everything back to the brokerage firm. And last but not least, mistake number 10 is not thinking about taxes. I always emphasize these things because, especially when it comes to taxes, this is detrimental. If you don't think about it, it's going to come around and bite you at the end, because at the end of the year, when you take your papers to your CPA to prepare your tax return, most likely, if you trade frequently and if you buy and sell frequently, most likely you're going to owe taxes on those monies. Now, whether you leave it in the brokerage account, whether you don't take the money out, whether you roll it into another investment, it doesn't really matter. The minute you trigger some kind of sale on a gain that you made on a stock, you're going to have to pay taxes on it. So you always have to keep in mind that the longer period you leave it, the better for you. You don't have to think about buying and selling all the time, and then you're going to trigger some kind of taxable event every time you do it. Same thing with your retirement accounts, 401k, IRA, anything like that. If you buy and sell within the 401k or an IRA and it's tax deferred, that's okay, as long as you're not pulling the money out. Now, if you pull the money out, that's a big deal, because if you pull it out before retirement age, you're paying 10% penalty for early withdrawal, and then on top of that, you're going to pay taxes on that money. So you're going to pay a lot of money just to get the money out of there. If you don't need it, please don't do it. Try to avoid it as much as you can. Have an emergency fund on the side so you don't touch those monies pretty much at all until you actually reach the retirement age where you can actually enjoy withdrawing from it, and you're going to pay as little as taxes as possible at that time. That was it for today, guys. I hope that was helpful, and until next time.